So to pivot off of that, Francisco, where does it make sense to invest in commodities right now?
Thanks, Alex. We think the commodity complex generally is benefiting from reflation coming from increased industrial activity. So that's been, for the most part, driving metals prices higher. And of course, we've also seen a lot of upside pressure on the gold, silver, precious metals complex, mostly driven also by central bank easing and very large fiscal deficits. And then energy, I think, remains the laggard, and it remains the laggard mostly because, as we've said repeatedly, COVID-19 is a mobility crisis, and to the extent that we're not moving, oil demand is not fully recovering. So we're keeping a very close eye on vaccines, treatments, and hoping that in the course of the next few months we see some of those coming online and hope and essentially bring back a recovery in consumption. That's the main thing that energy is missing right now.
Francisco, let's stay with that energy theme. Ursula von der Leyen is significantly accelerating Europe's push to more sustainable energy sources. We saw the BP reports earlier on this week talking about peak demand for oil. What happens next? How big a shift is this from Europe? How big an impact is it going to have on oil demand, and what does it ultimately mean in terms of pricing?
Well, look, I think BP's report is partly there to justify the corporate strategy. A lot of the European majors are essentially trying to become renewable power companies, and they've been working hard at it for the last few months. Question mark is whether, number one, they can do it, and number two, how quickly is this transition really going to happen? And one of the biggest, I think, one of the biggest unknowns is the U.S. election on November 3rd. I think under presidency under Biden we'll see a much faster energy transition. If we get 4 more years of President Trump, I'm not sure we're going to see a big push towards this so-called energy transition. That maybe slow down meaningfully here. So I think November 3rd remains a key date for that climate change fight.
Definitely when it comes to the U.S. For Europe, though, it feels like the fight is already over. I mean, the plans that have been laid out seems like you could really look at a combustion engine being phased out, completely, a total revamp when it comes to aviation, for example. If Europe was like the product sinkhole for a while, like what happens now if that market really shifts much faster to something else?
Well, I think obviously the emerging markets are the obvious place for fuels to go. We've stated in our medium-term range view, which we released a couple of weeks ago ahead of everyone else, that oil demand would peak in 2030 at around 105 million barrels a day, and that's probably down from around 108 million barrels a day prior. So we've shaved off about 3 million barrels a day to our trajectory. What happens from here to 2030, I think is very much related to the recovery in driving demand. And look, it's no secret, China has seen a big rebound in driving activity because people don't want to get into public transport. And the same thing we're seeing in the U.S. And even though there is a big move to work from home, and maybe we're not seeing school buses floating around as actively as they should be at this time of the year, we are going to see, I think, a big pickup in driving activity into the mid-2020s. Thereafter, I think it depends on how quickly EVs are pushed out and how the subsidies evolve. For the time being, What's happening, Alex, is that second-hand cars are going up in value. And again, these are not electric second-hand cars, they're just conventional internal combustion engine cars. So that's the reality.
Let's talk about one trade that you can potentially make around this shift, though, to a lower carbon future, and that is in carbon. Do you buy carbon at this point? We've also seen the European Union today suggesting that it's going to tighten up on the availability of free carbon permits. Is that just a one-way bet? Carbon costs are going to go higher and higher.
Right. So there's a couple of things, a couple of ways to look at this. I mean, carbon obviously at the moment is a local commodity. It shouldn't be. It should be a global commodity, but it's a local commodity because it's regulated at a national, or in the case of Europe, at a transnational level across the European Union. But But the reality of the matter is that carbon is a local commodity today. Is it going to go higher? Yes, I think over time it will go higher. Remember, the global average price of carbon right now is about $2 to $3 a ton. Because remember, most countries are not taxing their carbon emissions. So even if you see a price of $20, $30 a ton or euros a ton on the screen, it doesn't mean every country, every company is paying that price. Will we go higher? For sure. If we want to really limit climate change and limit temperature increases, we need to see carbon prices in the $50 to $100 range, probably closer to 100 than to 50. And that, again, is a huge hit. It would primarily impact thermal coal prices. It would pretty much push them to double the cost of what they are today. And I would think also it would impact oil prices very meaningfully. It will impact eventually also natural gas. So you need a price of carbon that's very, very high to fully engineer a rotation towards the Paris Agreement climate goals.